seconds.
Hello and welcome. I'm Chieh, the President of the Institute and Faculty of Actuaries. And it's my pleasure to welcome you to the second event of our Finance in the Public Interest seminar series. This series has been generously sponsored by Hong Kong-based philanthropist, IFOA fellow, Dr. Patrick Poon, and Milliman Consulting. Thanks to their support, we are able to host this event today free of charge to both members and non-members. At the last count, there were almost 500 people tuning into today's webinar. And I would like to extend a warm welcome to you all. I would like to spend 5 minutes to give you some context to the inspiration of this thought leadership program before I introduce today's speaker, Sir Paul Collier. Through our new program of events, which you can see on this slide, we want to bring thought leadership to the foreground of the IFOA once more. We seek to reposition the IFOA as a center of key societal debates, some of which are profoundly actuarial, while others reach out beyond traditional actuarial thought. We aim to cut through the noise, add to the debate, and move the conversation forward, and aim to build the IFOA reputation as an authority to execute our public interest duties. It is also in keeping with a growing desire within the profession to be more outward-looking, to be more forward-looking, to be bolder, to move beyond the technical debates and to take our conversations to a higher level. I acknowledge a single swallow does not a summer make, but I hope this program and series of events will make a start to reposition the profession and extend our influence in society. We began the Finance in the Public Interest series yesterday, which seeks to convene leading voices, economists, and thinkers on finance to discuss what needs to change within our financial sector and our systems to ensure a more sustainable future for humankind. We had a great and engaging session yesterday on radical uncertainty, anchored by John Chieh. And our discussion extended into the shortcomings and failures of regulation in two industries, the pharmaceutical and the financial services industry, and the disaster of moving from defined benefit to defined contribution schemes in the pension sector. John Chieh also wondered if you're attracting the right people to these industries. And I know this will set the stage for Paul Collier to talk about culture and ethics later on. As you can see from the slide, apart from the distinguished guest speakers like John Chieh, Paul Collier, we will have Andy Haldane, Chief Economist of Bank of England, on next Tuesday. We will also hear from our own members and IFOA own thought leaders, Louise Pryor, Ashok Gupta, Lucy Say, Nico Espinal, and Nick Silva, who each will represent distinctive and diverse perspectives on this multifaceted problem. The IFOA has been part of many responses to consultations, policy discussions, and public pronouncements over a wide range of issues over many years. Very often, they are technical and regulatory in nature and restricted to certain policy questions. There is now a growing recognition that the problem confronting us is actually systemic and more entrenched, wider, and of a higher order. Too many things have gone wrong in our generation: climate risk, biodiversity loss, accounting scandals, financial scandals, intergenerational unfairness, lack of economic income and health security, inequality, the poverty of the regions versus the metropolitan centers, financial exclusion. There is increasing public discourse that the philosophy, culture, and assumptions underpinning our economic models, financial systems, and regulatory arrangements have contributed to the existing crisis and the slow worsening of outcomes from a societal perspective. there is a need to change the conversation. The IFOA and the actuarial profession must be part of this new conversation. There are a plethora of issues for us to consider in this conversation. We will not be able to consider all of them in this whole series, let alone today. But it is important that we acknowledge them and see how they relate to one another so that we can fully appraise the scope and the relevance of the challenges and opportunities before us. From my discussions I have with the speakers in this series and from the work they have published, I have grouped what I consider to be areas of focus which the actuarial profession can speak to. And I shall just read the headings. The purpose and responsibility of the financial sector. And this is the initial problem statement, which is of great interest to FinSTIC, the Financial Innovation and Systems Thinking Innovation Center, FinSTIC. And the second one is on sustainability and diversity, which is a much bigger problem statement, which is a great interest to Sustainability Board. And the third one is how we navigate from market capitalism to a more pragmatic capitalism, changing the context, and something which is the work which is done by the members interest group of the economics members interest group. Fourthly, pragmatism and the role of the profession, on what the role the profession can play in this more pragmatic world. The speakers tomorrow will speak to all of these topics from their own perspectives. Culture and the ethical society, which is at the heart of the problem, which I believe Paul Collier will speak to later on today. And an appreciation that all these problems are interlinked, and we form a big, wicked problem which we must be able to address in a thoughtful and responsible way. And lastly, that this is an inflection point for our profession if we want to pursue our public interests as described in our charter. Now that I have provided you with a context to the inspiration of the Thought Leadership Program and the Dr. Patrick Poon Presidential Series, I'm delighted to introduce today's guest speaker, Sir Paul Collier. Sir Paul Collier is Professor of Economics and Public Policy at the Blavatnik School of Government at the University of Oxford and a Professional Fellow of St. Anthony's College. From 1998 to 2003, he took a 5-year public service leave during which he was the Director of Research Development Department of the World Bank. He is currently a Professor Invité at Sciences Po and a Director of the International Growth Center. He has written for the New York Times, the Financial Times, the Wall Street Journal, and the Washington Post. In 2014, Paul received a knighthood for services to promote research and policy change in Africa. Paul has authored numerous books, including The Bottom Billion, which won numerous literary prizes, War, Guns and Votes, Democracy in Dangerous Places, The Plundered Planet, Exodus, How Migration is Changing the World, and The Future of Capitalism, Facing the New Anxieties. His latest book, co-authored with John Chieh, is Greed is Dead, Politics After Individualism. After the lecture, there will be a question and answer session. You can submit a question at any time via the online Q&A function on Zoom, and I would encourage all of you to do so. This session is also recorded and will be available to view on our website afterwards. On this note, it is my pleasure to hand over to Sir Paul.
Well, thank you very much. Thanks for inviting me, and thanks to the audience for sparing the time to listen in. So I've just written this book with John Chieh, Greed is Dead, and it was John's idea that we write it together. we'd already been working together. So I knew about his work that has culminated in Radical Uncertainty. And he knew about my work and commented on it, which came out in The Future of Capitalism a couple of years ago. And it was John's idea that we really needed to fuse his thinking on radical uncertainty and my thinking about the anxieties being generated as we look to the future of capitalism. And that fusion is Greed is Dead. And is very much focused on the mishandling of risk by the professions. And the punchline of what I'm going to be telling you, trying to persuade you of, is that the risk profiling that your profession is doing has actually increased the exposure of our societies to risk. And since that's if I'm right, that's a disastrous thing, very embarrassing thing for a profession, let me first of all reassure you that the same thing has been going on in pretty well all the professions. You know, to get a British passport, you need to get the photograph signed by, it says, by somebody in a profession, and it lists the professions. And why is that? It's a hangover from a time when the professions were all not just about skills, they were about ethical standards. They were the ethical towers of the society. You were able to trust a bank manager, trust an accountant, trust a lawyer, and even trust a professor. Right? So that's the benchmark that we had until about 50 years ago. And then what happened was a very good thing, isn't a very bad thing. A very good thing was that all our professions got more skilled. And we became more specialized, more technocratic. And that was a good thing, of course. We're better able to quantify things. But that came with a disastrous phenomenon, which was a narrowing of our focus and a loss of a sense of ethical purpose. So let me give you a few examples of that. It's, as I say, it's across the professions. Let me start with British lawyers. You'd hope that this would be a very, very ethical profession. So let me go to one of the biggest and best remunerated law firms in Britain, Magic Circle law firm, Linklaters. Well, Linklaters signed off a request by Lehman Brothers. Lehman Brothers was, of course, based in New York, and it had gone round all the law firms in New York to try and get a legal opinion saying that its vast explosion in derivatives trading was okay. And none of the law firms in New York would produce that legal opinion. And so it came to Britain and went to Linklaters. And one of the partners of Linklaters duly obliged. When I last checked, Linklaters partners were paying themselves £1.8 million a year. This is known as the Potts letter. It's a famous letter because it was palpably a ludicrous opinion, but because it was signed off by a partner at a Magic Circle law firm, that was considered good enough by Lehman Brothers to massively expand this derivatives trading. And because of that legal opinion, the regulators basically decided to back off. They were outgunned by legal opinion. It turned from tragedy because, of course, Lehman Brothers went bankrupt, and with it triggered the entire global financial crisis, cost to the society something north of $9 trillion. But just to add a little twist of amusement, when Lehman Brothers went bankrupt, and it was then handed to an administrator, and whom became the administrator, Lehman Brothers. So having produced the legal opinion which bankrupted the company, causing catastrophic side effects, it then became the funeral director. So that was an example of a loss of ethical purpose in the legal profession. And of course, that continues, unfortunately. If we look at my own profession, economists, we were in a very, very embarrassing position, crystallized when the Queen visited the London School of Economics and asked a very simple question. Why did nobody see the financial crisis coming? That, I have to say, produced something close to a mental breakdown in my profession, and a very, very long reply sent, I think, to the Duke of Edinburgh to try and justify themselves. But it's actually very embarrassing because in 2007, just before the financial crisis, the International Monetary Fund, which is staffed entirely by people with doctorates from good economics departments around the world, the IMF had produced its annual report saying that thanks to the growth of derivative markets, the economic system was now much safer than it had ever been. That was 2007, and 2008, it all blew up. So that was really quite unfortunate. It was also predicted by one very distinguished economist, Raghu Rajan, professor of economics at the University of Chicago, so holy of holies of orthodox economics. But what Rajan did was stand up at the Jackson Hole Economics and Finance meeting in 2006. I was there, and he said he predicted the financial crash. He was promptly denounced by other economists, but he publicly stood up and predicted it. Rajan is a very interesting figure because he's just come out with a very, very good book called The Third Pillar. Rajan is probably the most distinguished business economist in America. He's, as it were, the counterpart to John Chieh in Britain. And Rajan's book is called The Third Pillar. And what is the third pillar? The third pillar is that pillar of society which has become missing as a result of the last half century. And that third pillar is community. Here is the top business economist in America saying societies cannot function if they neglect community. And the essence of community is mutuality and reciprocity. Now, what Rajan is doing, what John Chieh is doing, what I'm doing, part of a much wider intellectual movement. And I wanted to turn from this sort of critique of law, of economics, and so on, to this new intellectual revolution, which begins, I think, not with economists like Rajan, but with evolutionary biologists. There are two very, very, very distinguished evolutionary biologists whose work is fundamental here. One is at Harvard, one is at Yale. Yale is Nicholas Christakis, and Harvard is Joe Heinrich. And they've both got very important new books out in the last 18 months. And what they're saying is that we need to reassess what human nature is. My own profession, economics, came up with this account of human nature in the 1950s called Economic Man. Economic Man was greedy, lazy, and selfish, entirely self-interested. And we thought in the 1950s that that's what Darwinian evolution was telling us. And that turns out to have been a devastatingly wrong account of human nature. What do we now know about human nature? We know that humans are a very, very unusual mammal. We are a mammal, so somewhere deep in our heads, we've got the instincts of all other mammals, and other mammals pretty well are greedy, lazy, and selfish. But we've evolved to be very much more than that. And the reason was evolutionary pressure. When we came down from the trees, we could only survive by cooperating together in large groups. And so we evolved through a process of natural selection to be first and foremost creatures of a community. We let our community do most of our thinking for us, so we're guided by the collective brain of our community. Over the last few 100,000 years, the size of our individual brains has actually shrunk. We're probably less smart individually than Neanderthals were, because we don't need our individual brains as much. We're guided by the greater wisdom of our collective brains, the store of knowledge stored up in our community. So we're guided by a collective brain, and that's the smart thing to do most of the time, because the collective brain has got eyes from 1,000 eyes and many years, which is stored in the communications of the community. That's what communities are. They're arenas in which ideas are circulated. So we're by nature communitarian, and we care a lot about getting the good opinion of other people in our community. And so we're willing to sacrifice our own individual interest for the collective interest of our group in order to get the good opinion of the group. And you see that again and again in daily life. You yourselves really care about the opinion of other people in your family, of other people in your profession, and other people in your firm, and so on. So that is human nature, and we're able to build that sense of mutuality at many different levels. And so a good organizational culture encourages us to build a sense of mutuality in rather a large group. To give you an example, that's what Toyota did about 60 years ago when it started to try and break into the US car market. And Toyota had managed to build a sense of common purpose. Its leaders persuading the workers that producing a fault-free car was a very good thing to do, that they would all be working towards that common purpose together. And so the leadership of Toyota was sufficiently modest and good at communication, that it built that sense of we have a common purpose, build a fault-free car. General Motors was, in the 1960s, the most profitable company that ever existed on earth. And so it got all the management consultants, all the rest of it. By 2009, it was bankrupt. And we know what bankrupted it. It couldn't compete with Toyota. And that wasn't because Toyota was a lower cost producer, very far from it. Toyota was producing cars a long way away at smaller scale than General Motors. General Motors' disadvantage was entirely that it had had an oppositional relationship between management and workforce. And so it could not persuade its workforce to build fault-free cars. And so the reputation developed quite correctly that if you bought a Toyota, it wouldn't break down. If you bought a General Motors car, just good luck. You know? And that reputation was what bankrupted General Motors. And behind that reputation was this ability of Toyota to bring people up to this sense of working together in a huge team. Whereas General Motors had dragged people down to the crude mammal of greedy, lazy, selfish. And so everybody was in it for themselves. And so organizational cultures can either take us up like the management of Toyota did, or down like the management of General Motors did. And that is the building of a culture in an organization. And the same is true of the building of a culture in a profession. So from that, I now want to turn to practical examples of what has been going on in the actuarial profession and just how much damage that has done. And I'm going to start with a pension fund. John talked in general about pension funds and what a disaster the unwinding of defined benefits was. But I'm going to talk specifically about one pension fund, which is supposedly the biggest and most bankrupt pension fund in the whole world. And that is the one I'm in myself. It's the university's superannuation scheme, USS, which is the monopoly pension provider for all of Britain's universities. Now, that has been declared by the actuaries to be massively, massively bankrupt, basically, that the value, the cost of the liabilities massively exceeds the assets. Now, how is that arrived at? Because as John Chieh has explored in great detail in this case, it's completely false. Right? But the claim is having devastating consequences. So why is it completely false? Because it's based on a totally spurious calculation, which is to say, if you wound up the scheme today, so you valued all the assets today, you liquidated them, and you valued all the liabilities today, what would be the value of the assets relative to liabilities? That is a, you can do that as a thought exercise and you come up with a big deficit. It's completely irrelevant. Why? Because the British universities are not all going to be wound up today. Take my own university, Oxford. Oxford has just issued a bond which will not be repaid for 100 years. So it's a 100-year bond. It wanted to borrow $700 million, so about $1 billion, 700 million pounds for that bond. The bond was massively oversubscribed and carries an interest rate of about 2%. Inflation in Britain is projected to be a little more than 2%. So we at Oxford University have borrowed $1 billion at a real interest rate of 0, and we won't pay it back for 100 years. Why? Because the financial community knows perfectly well that Oxford was still here in 100 years' time. So this was a AAA rated bond. And it knows that our financial base is that we can charge whatever level of fees we charge. There are thousands of families around the world wanting to get their kids to Oxford, and so they would be willing to pay it. And that's basically the underwritten, how Oxford's finances are underwritten. The reputation of the university as a world-beating research university. So it's completely pointless doing a hypothetical exercise of suppose Oxford ceased to exist tomorrow. Nobody in their wildest dreams imagines that it's going to, nor any of the other universities. Right? So it's what is underwriting the pensions in USS is not the asset base. It's the fact that the British universities, 90 of them, will go on forever. We'll have a gradually increasing number of students, gradually increasing levels of fees, and so we'll be able to pay their academics and employ more academics and contribute into the pension scheme. So the attempt to do this actuarial calculation was a completely bogus exercise. It was nothing to do with the actual risks facing the pension fund. Right? But the claim that it's £20 billion in deficit is having a devastating effect, not just on the universities, but on the risk profile of the whole of the United Kingdom. Because the consequences of that claim is that USS has been panicked into saying we will have to have a massive increase in contributions from the British universities. And this is at a time when the government, of course, is not increasing funding for universities. And so if universities like Oxford have to pay a lot more into the scheme, it can only come from one resource, and that is the research budgets. And so there will be a drastic reduction in research expenditures. Now, why does that matter? Not just for the universities, but for our society. Well, Britain has two towering world achievements. One is its universities, and the other is the deep pool of finance of the City of London. So we have 18 of the world's top 100 universities. No other country has anything like that number of top-ranked universities per million of population. So we are a world-beating place for research, because what is the rating about? It's about research. And so Britain's future, now that we've left the European community, I should say the European community with a population of 500 million, nearly 10 times ours, has only 6 of the world's top 100 universities. So Britain's big strength is its universities. And we need to connect the ideas coming out of the universities to the deep pools of finance in the City of London. That's just what happened with the Oxford AstraZeneca link up, which has produced this game-changing vaccine against COVID. So that's just an example. So we desperately need to preserve our research universities and harness those ideas better by linking them more closely to the deep pools of capital. What USS action is doing is going to break Britain's university research capacity. And with that, destroy our best chance of being a thriving economy over the next 50 years. What's caused that? A completely foolish bit of actuarial calculation. So in trying to make the pension funds safer, people like me safer, what it's actually done is make the future of my children much, much riskier. Now, I've got one kid who's already at one of these top universities. I've got two kids in their early teens who I hope will go to them. But by the time they go to them, if USS policies are maintained, we won't have 18 world-class universities anymore. So that's one very practical example of how an actuarial ruling was, which purported to be a risk profiling of a pension fund, was actually completely disastrous. And I should say I'm working very closely with Whitehall. Last week I was on a call with the minister responsible for skills and research and higher education in Britain. And he is absolutely anxious about this ridiculous ruling because he sees the devastating consequences of it. Let me turn to another, which is the behavior of banks. And I get some of this information from directly from the team that's running Lloyds Bank, and some from my friend Bridget Rosewell, who used to be chief economist of Britain's CBI and is now chairman of a bank, which was trying to lend to small firms in the Northeast. And they found that banking regulation prevents them from actually lending to SMEs. And so over the last 10 years, there has been a complete shriveling of relationship banking. Relationship banking is where the local bank manager gets to know the local firms, gets to know which managements can be trusted, what the problems and opportunities are, and so is able to use his or her judgment in determining whether it's safe to lend to a firm. And that used to be how banking was conducted. It isn't anymore. Now, it's done by algorithms. And so all that the local bank staff do is fill in a form, and it's then run through an algorithm. So relationship banking has just collapsed. I'm doing a series of interviews with small firms in the north of England at the moment. Yesterday I was on a call with a construction firm. It's a developer. They told me in the developer business, where you buy a plot of land or you buy a building and you renovate it and sell it on, knowing the local context is everything in determining whether you manage the risks or not. So knowledge of it, the guy said, my job is all about relationships. His own firm had been running since 1966. When it came to 2009, the bank that they'd been banking with ever since 1966 suddenly said, sorry, we don't want to do business with you anymore, pay it all back. They had 6 weeks in which to pay back the entire loans that they'd got. And there was a desperate family scramble to manage that. So the firm was nearly bankrupted by this basically algorithm decision. No, we don't want to finance anything that's in the construction development sector, just get the money out. Right? So that's the collapse of relationship banking. And it's a disaster. Bridget Rosewell, the chair of the Bank of North East England, says we can't legally not allowed to do it because the banking regulators prevent us. And why are the banking regulators doing that? Because of this concept of risk profiling, which is what the algorithms are based on. Of course, that means that it's very much harder to get startups going and to get startups to then scale up. If you contrast that with what's going on in Silicon Valley, why is Silicon Valley Silicon Valley? Because there are deep pools of risk capital by people who are very wealthy and don't do any of this risk profiling. Their approach is know the guy, know the person. Are they driven? Have they got a good idea? Are they hungry to try to put it into action? And so they back the people with an idea. And that's based on a lot of personal knowledge. And they build up a portfolio. And they're hugely successful. But if you stuck them in an algorithm, it would always come out done. Right? And yet the future of the world economy depends upon people saying yes to these startups and scale-ups. Let me turn, and I'll draw towards a close in a bit, but let me turn finally to Legal and General. I was on a call with head of Legal and General just last week, and I have to say he's completely furious with the actuarial profession. Partly because he produced a big report for him back in January about the risks that Legal and General was running in their life assurance and that sort of thing. And it was all very, very fancy estimates of, actuarial estimates of how long were people going to live. It was done in January last year, January 2020. It didn't have a single word about pandemics, not a word. Right? Indeed, I was at Davos in January 2020, not a word about pandemics. Right? And so this elephant, this was the equivalent of not anticipating the 2009 financial crash in the economics profession. COVID has completely upturned demographics, apart from anything else. Has changed both mortality and dramatically reduced birth rates. So it's not that you had to forecast it in detail, but by January, you certainly should have been aware of the risk of pandemics. And so instead of fussing about the technocratic detail of of actuarial demographics as based on the past, the recent past, you should have been lifting your eyes above the parapet and seeing COVID rolling in from East Asia across Europe. And of course, it won't be the only disease to roll around. And disease won't be the only risk. So lifting your eyes to these larger horizons. What Legal and General was particularly angered by was that in Britain, they are not allowed by prudential regulation, they are not allowed to invest in portfolios of small firms. So there is all this financial power at their command, all this potential of small firms for growing, and no link between their financial firepower and the ideas generated by Britain's 18 world-leading research universities. He wants to put Legal and General's money into portfolios which invest in small firms that are coming off the sparks of ideas coming out of Britain's leading universities. That is going to lead to a rate of return which is much higher than the rate of return on the AA and AAA bonds, which in real return is zero on AAA assets. Whereas the real return on SME portfolios is typically something above 5%, something between 5 and 10%. So he knows that his pensions are in deep trouble, his life assurance is in deep trouble, because he's restricted to a class of assets which basically condemns his portfolio to fail. We have to be prepared to take some uncertainties on board. Otherwise, we will doom ourselves to impoverishment. So on that note, let me draw to a close and return to your profession. I've put in rather a powerful challenge. I think your risk profiling has made my society, Britain, much more dangerous.
Thank you, Paul, for your provocation and challenge. I have many senior actuaries with me, and I think we want to respond and engage in a thoughtful way, without getting into rabbit holes of details. But if I were to summarize your presentation into 4 observations or group of observations, because they are of a very different order and levels. You opened the presentation about the importance of communitarianism or group interests, mutuality and reciprocity as a fundamental requirement for a good functioning of a society. And I think that is evidence from your literature, but the zeitgeist we lived until recently was the Washington Consensus unleashed by the Friedman Revolution about maximization of stock market prices, and that has marched on until it unwinds, unwound in a global financial service crisis, right? So that, and many of the rules and regulations from Basel II and pensions and our risk-based capital and value at risk is still anchored in those thinking, which led to the tragedy of commons and the tragedy of horizons, of which many of our colleagues work within the regulation and what I call the small world thinking, right? So they are doing their work in accordance to what regulations required, but regulations is not necessarily responding to what is going on. But it's very hard to unpack that unless we do it together. And that is a question being asked by the head of FinStic, Ashok Gupta, which I will raise later on. So that's the first observation you made. So for me, it's culture and ethics, because fundamentally you went into ethical issues about collective interest. But my challenge as well is that a completely collective interest society may not produce the kind of innovation unless you have a balance of private interest or personal interest. We can talk about that. So that is category one. The pensions problem of the superannuation scheme for the universities is a manifestation of that. It's a manifestation of that because of how we ensure solvency of schemes within the regulation setup. Even the regulation might be anchored in a wrong philosophy for too long. Yeah. So there is, in fact, the birth of this lecture series was anchored on our feedback to Her Majesty government on the inadequacy of just addressing regulations. We must ask what else is going on, and how do we change the narrative at the Bank of England or in the higher echelons of power. You could ask John Haldane on Tuesday, but obviously it's not the effort of one person. Yeah, it's a wicked problem. So that is the pension issue. The third one, which you raise very clearly, and it speaks to Toyota and also the community bank and the importance of communitarian banks and cooperatives. Yeah, and rules are not set up not just for banks but even for cooperatives, which does not augur well for mutuals of the future if they want to work on a cooperative basis, because of the way they count capital for cooperatives and I suspect for banks. Yeah, but that again is a function of regulation. But we could also go into that conversation that even for mutuals and cooperatives for which I worked for 10, 14 years, they do not necessarily produce very dynamic organizations. Yeah, that's the third point. And the fourth point you made was about legal and general. And how come even pandemic crisis was not visible? If I hear you correctly, how come pandemic crisis is not even within their radar, and it's also not in the radar in the World Economic Forum? That is a great question, because I have a sense that we are ticking the boxes, right? In many of our risk management, right? They're not asking the bigger question, what would go wrong? I would like to introduce a question on regulation and pensions from Ashok later on, but I wonder whether you would like to respond on of a profession of our size and of our standing, without being subjective about it. How could we help change the conversation with people who set the rules?
Yeah. So first of all, these things do change. Right? We can look back through the history of the last 150 years and see very clear turning points where a whole tide of ideas either shifted towards communitarian thinking or shifted towards short-termism and individual thinking. There's a wonderful new book by Robert Putnam called The Upswing, which traces that over the last 140 years in the United States. He identifies an inflection point around the year 1900, when society had been very, very individualistic and started to become much more communitarian. And then another inflection point around the 1960s, when a society which had become probably too communitarian and consensual started to become more individualistic, and has carried on becoming yet more individualistic right up to COVID. And I think what is now happening is, partly thanks to COVID and partly thanks to this mass of new ideas across the academic community, from philosophy to economics to politics to sociology to psychology, you're starting to see another upswing towards communitarianism. So there's certainly a pendulum that shifts very considerably. If you compare the thinking now to the thinking 50 years ago, it's radically different. Something changed it. What changed it was the conversation gradually changed. And that happens within the professions. Each profession has a running dialogue within it about ideas. Yours very obviously does. You're part of it. This event is part of it. And that dialogue is the process of inch by inch shifting ideas. As you all start to talk about this through your networks and compare what you think and use examples and start to read what the latest academic thinking is, then that will shift. Ideas are not frozen. They really do swing. You're quite right that you don't want a society that is purely collectivist. That would be very stagnant. But what you need is a society where there's sufficient common purpose about goals, but pragmatism and agnosticism about how to achieve those goals. And then with a common purpose, you can devolve to much more decentralized teams, each of which tries to search for that same common purpose, but innovating in its own ways. And that is indeed the genius of capitalism, is a decentralized process of experiment. But it's vital to match that decentralized process of experiment with an overarching ability to build a common purpose. That's what Toyota did. That's how it defeated General Motors. It had built a common purpose, and then it was able to devolve right to the production line, the business of how do we actually produce a fault-free car. The answer to how to produce a fault-free car was not devised by Toyota's management. It was resolved foot by foot, yard by yard, on the production line of that General Motors, of that car production line. So Toyota decentralized around a common purpose. And that's what General Motors wasn't able to do. It wasn't able to build a common purpose, and so it wasn't able to decentralize. General Motors had a highly centralized system run top down, but it didn't have a common purpose. And so it wasn't dynamic, and it went bankrupt.
That is a wonderful reminder of the flow of history. I think many of us in this call did remember the Thatcher Revolution and the Reagan Revolution riding on Friedman and Frederick Hayek and the march of the Washington Consensus as a reaction to the stagnation and the fossilization of Krangos in the UK in the 70s and all that, and the concern about the big state. But now states are even getting bigger in the world of the new capitalism. So I think some awareness about cycle of history is useful, and communists or China requires the spirit of enterprise to invigorate within the communist system in order to unleash what is very much a private incentive. So the issues are not so straightforward, but I want to take it to the actual world, and I want to combine two questions from my esteemed colleagues Ashok Gupta and Nico. Ashok want to follow up with your assessment, because this is a real question in a sense that it directly impinges on what we do on a year-to-year or a day-to-day basis. Ashok agrees with your assessment of the superannuation scheme, the university superannuation scheme. While you attribute the problem to actuarial practice, the reality is that actuarial practice is driven by regulation based on financial economic theory. how do we build consensus between actuaries and economists to change this? Yeah. And I think there is a connected question. If I could find a question. Okay. More specifically, the concept of guarantees, because defined benefits has implicit guarantees on final salary schemes and all that, and consumer protection. I assume, this is from Nico, I assume you are willing to enable guarantees to have a greater risk of not being paid. What issues does we bring up? Yeah.
Okay.
Yeah.
Very good. So the second point, look, the collapse of the defined benefit system occurred because of lawyers. Lawyers misinterpreting the commitment of pension funds to pay a pension which matched inflation. They misinterpreted that as a legally binding commitment. Of course, it couldn't possibly be a legally binding commitment. It was basically a statement of best effort and an expectation that normally this would be feasible. It would be feasible as long as you invested sensibly in profitable businesses, that your profits would rise with inflation, and so your pensions would be able to rise with inflation. As long as it was expressed like that, as an ethical commitment to use the best efforts of the pension fund to maintain the real value of the pension, it was perfectly viable. There was an implicit force majeure there that said, if a catastrophe happens, of course we wouldn't be able to. But once the lawyers reinterpreted that as under any circumstances, this is legally binding, it became ridiculous, because the essence of radical uncertainty is that you cannot produce these guarantees under all circumstances, because you cannot anticipate what all circumstances will mean. And so that was that moving from an implicit interpretation of this will be the intention and the ethical commitment of the pension fund. It will be run in such a way that under normal circumstances, the real value of your pension will be maintained through your lifetime. Moving from that to a legally binding commitment, I can now go to the court, and whilst ever any one of Britain's 19 universities is still functioning, I have a legal right to my pension being paid in full, compensated for inflation, regardless of whether British society totally collapses. That's a ludicrous misinterpretation of the defined benefit scheme. So that was the problem, the move to a legally binding commitment, which under the circumstances of radical uncertainty is just a nonsense. To go to your former question, the idea that properly understood economic and financial theory compels these actuarial calculations is just plain false. I mean, that is, John Chieh is probably the finest mathematical economist of his generation. He's produced this very sophisticated theory. John will be the very first to say that theory doesn't compel you to behave in such an idiotic fashion. On the contrary, once you've understood the theory, it compels you not to do that. So this is the conversation you need to have, that people are operating under a very outdated misunderstanding of what modern economic theory and financial theory is telling them. And so basically the answer is get up to speed with the intellectual revolution. And that conversation is what needs to happen. And of course, once the regulators themselves get up to speed, these things will change. I mean, they definitely will change. We can say very near to as near to certainty as possible. Over the next 10 years, all these things will change. You can either be ahead of the curve or behind the curve. It's very much better both for society and yourselves if you're ahead of the curve rather than behind it. Raghu Rajan went up in everybody's estimation by calling out the financial crisis 2 years before it happened. He went on to become the governor of the Reserve Bank of India, and is hugely respected.
John, I share your hope and probably your optimism that it will change. But clearly, Ashok's question and to a certain Nico's question is that at the highest levels of rule setting and of philosophy setting and of leadership is to ask the question, what's going on? You reduce it to the legal issues, right? About the role of lawyers, but I can understand how individually as professional we still have our care and competence and our training, but we know that this is not producing the best outcomes in the long term, but you are still constrained. But I think that there is a tipping point which is emerging, and is how we could join forces to ask the question, what's going on and what needs to change. It might be a very good first question to ask Andy Holiday next Tuesday. Yeah,
yeah, absolutely. And of course, both John and I know and
we've got a few
the interest of Andy Holiday. So yeah.
And I think this is also an Andy Holiday question, but we can have a trial run. I did agree to Michael Clark, who wrote a rather interesting piece on the social media recently. And in his piece, he portrayed the government as the state chief risk officer. But his assertion here is that the government have delegated too many risks to capital markets, to price, and to risk which markets simply are not designed to price. Please comment.
Yeah, I think, look, delegation is safe once you got to this common purpose stuff. You've got to have some common understanding, as you say, the zeitgeist. And at the moment we haven't got that. That's the danger. But the cavalry of a big shift in intellectual opinion is now, sort of galloping over the landscape. Michael Sandel in philosophy, Rebecca Henderson, Raghu Rajan in business studies, Robert Putnam in politics, James Hankins in history. There's just a whole crop of these important books that are shifting the intellectual current across the professions. As I mentioned, the evolutionary biologist Joe Heinrich and Nicholas Christakis. So wherever you look, there's this shift in thinking, and that is what's actually those ideas will filter down. It's going to happen much faster because of COVID, because COVID is this sort of galvanizing experience which has revealed the importance of having some common purpose. I mean, let me quickly contrast a communitarian thinking society with an individualistic thinking society. So a good example of a communitarian response to COVID was Denmark, where Denmark comes pretty well top in almost any measure of economic prosperity and human well-being. And that's because it's very good at building common purposes and getting people to willingly comply with them. So here was a new common purpose: keep your neighbors safe from COVID. So protect your neighbor, and people did that. COVID didn't take. There wasn't a first wave of COVID in Denmark. There wasn't a second wave. There was a third wave, hit briefly at Christmas, and they got on top of it very fast. So that was a society which was a we society where people protected each other. And if we look across the Atlantic at America, I remember the first response exactly this time last year in America when COVID hit was long queues outside gun shops. There, the training that people had had over the last 40 years was not protect your neighbor, it was more shoot your neighbor. And of course, it turned out to be not a very good way of coping with COVID. Denmark had not only got a very low mortality from COVID, but also a very low economic hit, because with people individually taking responsibility, the economy was able to carry on. So it had a much lower economic hit than America and a much lower mortality hit than America, because it was able to agree a common purpose very fast and everybody be willing to comply with it. America was the opposite. Just look at it. It couldn't agree on anything, and there was no willing compliance with anything.
So I would like to go to a couple of questions which are slightly behavioral in nature from Oliver Bettis and Chieh, intertwining that. But before we leave this question about purpose and shared narrative and your comparison between USA and Denmark, and also reading your book. As a hierarchy, we need a purpose and a shared narrative. Otherwise, mutual obligations and reciprocity will not quite work. But we also need private interest, and it's a balancing of the two. But the question I have for you, because I get a sense that this community of communitarian purpose, it cannot be too globalized, can it? Because one of the issues we have in the last 20 years is about globalization and the maximization and the offshoring. And therefore, the emphasis on efficiency and growth has tipped the balance. So does it mean a smaller community in terms of, say, Sheffield or London, a shared national narrative or a shared community narrative? Because that is also much a very spirit of cooperatives and mutuals. But the moment they try to internationalize, it sort of loses its ability to hold a narrative together. So I would be interested in your comment, and then we go back to Chieh and Oliver Bettis. Yeah.
Sure. So what mutuality has to have some practical mechanism for people genuinely, for it being a genuine phenomenon. Mutuality, people have got to know who else is engaging in this mutual commitment and a mutual agreement about some common purpose. And so there has to be some practical mechanism of discourse. A community is communicates. So there has to be a practical mechanism of communication. Now it can be international, and your own profession is international. So it's not just a spatial, it doesn't have to be spatial boundaries, but you've got a professional boundary. You're either an actuary or you're not, you know, and that creates a sense of community around a particular purpose, and you can have an international dialogue. So it doesn't have to be spatially small, but you've achieved that by being focused. The same will be true of all the professions. Economics is an international profession, but it's bounded by membership of the, as it were, the club of economists. It depends where, it depends at what level action is needed. And so a lot of action is needed at the level of the nation state. You know, nation states typically handle something close to 40% of GDP. So a lot of things need to come at the national level. A lot of things also are actually better done at the local level or at the regional level. It depends on the nature of the problem at what level it's appropriate to tackle it. And so you need a system which can work at many different levels. But always the acid test is there a practical mechanism of communication within the group? If there's no practical mechanism of communication, then it's not a community. It's not a place, it's not capable of building mutuality.
Thank you for the answer, Paul. Nikki, if you want to, I would encourage people to fill up a feedback form. Nikki will put up a QR code because we are in the last 15 minutes of the presentation. I'm now going to ask you a question from Chieh, who is the head of our diversity action group. And her question is between two polar, okay, not two polar, but 2 points, which is about the university superannuation scheme. He asked, how do you reconcile the strong assumptions underlying the superannuation scheme and the challenge that pandemics were not spotted or considered? And she alluded to her observation there is a human reluctance and an inability to engage with big risks such as pandemics, and difficult to maintain credibility when considering extreme scenarios. And she said, arguably, with respect to the university scheme, the wide-out approach for evaluation allows for the possibility of a severe scenario, such as a pandemic. So this is quite paradoxical, yeah? So we can be very conservative, if I could use the word, in small risks, but ignore the big risks. But before you answer that question, there is another question from Oliver Baptist, which is about evolutionary psychology. And I'm trying to find it now. Yeah, just give me a moment. Just give me a moment. Okay. She said his question from Oliver Baptist is on evolutionary biologists giving us an insight into human nature. How are economists changing their models and techniques to incorporate the knowledge that humans evolved primarily to cooperate? Is this thinking being used in policy decisions? Actually, I could ask a small rider because on this question, because your answer to the global question of creating a community and having conversations, my question is simpler. It's very along the same lines as Oliver. Are people thinking about it, and are things changing? Okay, back to you, Paul.
Yeah, so the answer is very much so. Heinrich's book only came out in 2020. Christakis' book only came out in 2019. Christakis' Blueprint, Heinrich, Weirdest People in the World. These are very big books, and so it takes a little time for people to digest them. But that is certainly, we've had just in the last 18 months, books which will still be being read in 50 years' time and seen as epoch-changing contributions. They are landmark books, landmark intellectual shifts. Michael Sandel's The Tyranny of Merit is the same thing in philosophy. He's introduced this concept of contributive justice, moving away from the old Rawlsian distributive justice. Let's all have the same slice of the pie, was Rawls' idea. Whereas contributive justice is about us all baking the pie, contributing to the process of creation. Dignity comes from participation in contributing. And so a society of equality of condition, which is his phrase, an equality of condition is one in which everybody is in a position to contribute to the whole and recognizes their duty to do so. So these are earth-changing ideas which will be influencing societies still in 50 years' time. Are they being read and feeding into policy? Yes, right? There's a new intellectual foundation for ideas. So of that, I have no doubt at all. And I'm in very close touch with not just with the British government, but with leaders of major political parties in various parts of Europe. So I think this intellectual sea change is filtering through. The speed at which it filters through, I think it could have been anything. It could have been very slow, it could have been quick. I think COVID is really speeding it up because it is such a good illustration of why we need to have common purposes and a sharing of moral responsibility. We all need to be morally load-bearing, including the professions. This is what happened both in around the year 1900 and around the 1960s, where new intellectual ideas coincided with big public crises that illustrated what those ideas were saying. So in the 1960s, the intellectual revolution in America, away from community and state, was triggered by the catastrophe of America and Vietnam, and then quickly followed by the catastrophe of stagflation in the early 1970s and the oil shock. And so suddenly it became apparent that the state wasn't very competent, that the idea that the state was the solution to everything, which had emerged and been reinforced by the Second World War, suddenly turned sour with Vietnam and stagflation. And so the intellectual shift was amplified by this public catastrophe. And that's exactly what's happening now. An intellectual shift back towards communitarianism and common purpose is being amplified by the example of COVID. That's why I now think it will happen fast, not slow. You need to get ahead of the curve, otherwise you as a profession will find yourselves behind it.
Well, I have one more last question, but I am cheered and encouraged by your observation about the intellectual sea change, which is sweeping across UK and the world. And I like to think that the IFOA and the profession is on the right side of history. Ironically, one of the issues which caught us back foot in the 1990s and early at the turn of the century was our slowness in embracing financial economics. And what an irony it is that actually most of the issues now emanate from financial economics. And this could be about negative capability, right? And also about a quote which John Chieh said about the Renaissance, in your times of greatest difficulties, you create the greatest opportunities, and every solution every problem brings its own solution. So that was great. But one last question, which I think you could speak to us, which is what actions would you take to change the culture of the professions, in particular the actuarial profession?
So there's only one way to do that, and that is dialogue. And dialogue is an important form of communication which respects other people's opinion. And so dialogue, there is a duty to listen as well as to speak, to understand the other, as well as be as persuasive as possible yourself. And so dialogue is a process of mutual learning. And no view is completely right or completely wrong. As you yourself excellently pointed out, we don't want an entirely communitarian conformist society. We want a society which has dynamism and innovation, as well as a huge ability to cooperate and collaborate. And the architecture of that, this sort of common purpose but decentralized agency, that is where we need to head. And just getting that shared understanding, working towards common understanding in a dialogue, that's the thing to build. And if your profession can achieve that, it will be a huge contribution to the improvement of our societies. We will become safer. Thank you very much.
Sir Paul, thank you for your encouragement and to be at the center and to assist us in our dialogue and engagement. And I know I speak for many in our profession in appreciation of your time and of course also the power and the quality of your ideas. So thank you for having a dialogue.
I've got one last request. John, myself, Andy Haldane, all of these people who've contributed to a shift in the turning of the tide, we need ambassadors. We need people who use their networks to share these ideas. Please become ambassadors for a new way of thinking. You will do a lot of good.
Thank you, Paul. I'm sure there are many of us who are willing to be ambassadors and part of the new conversation. Thank you for the opportunity. So I need to do a few points of closing to draw the event to a close. I want to place on record again to Paul Collier for engaging us. In a very meaningful and effective way. Yeah? And I also like to thank our two sponsors again, Patrick Poon and Milliman. Tomorrow's event, we will be joined by Ashok Gupta, successful entrepreneurial actuary, chair of Mercer, and who's the head of FinStick, Financial System and Systems Thinking Innovation Center at IFOA. Nico Espinal, who was the past chair of the Resource and Environment Board, now called the Sustainability Board, who is a fairly radical thinker himself. Nick Silver, who has great expertise in climate change and investment systems. And Lucy Say, from the Sustainability Board, who has well-developed views and passion about intergenerational fairness and so forth. Yeah. So there's tomorrow at the same time, 8 a.m. Next Tuesday, the series will culminate in a panel discussion where John Kay and Paul Collier will be joined by Andy Haldane and my esteemed presidential colleague, Louis Pryor, who has been campaigning for climate change for as many years as I can remember, who will obviously help to bring the discussion alive for the profession. So I hope that you have enjoyed today's event, and the Thought Leadership series goes beyond finance for public interest. So I would encourage you all to sign up for the programs. And I would like you all to fill up the questionnaire if you can, so that we could have meaningful feedback. So with this, it concludes today, and thank you again for joining us. Goodbye to all of you. Goodbye, Paul, and goodbye, my friends in the profession.